Hey, what is going on, everyone? Welcome to another video. This one is going to be about the average daily range, or the ADR. So starting with the introduction, an ADR is a simple and powerful tool which you can use for finding the average range of the daily candles and pips or points if you are a future or forex trader. So by calculating the average of last X number of days, you are getting a projection or a value that how much the upcoming or the current day is going to expand, and that will prevent you from trading the overextended ranges, the lower probability environments, and it helps you understand how much expansion is left in a day, how much have we use, and what can I expect going into the newer session from the current day. And don't worry, I have already built an indicator for this, which will be released after this video for free. So this is the example or a showcase of that indicator, finding the average of the last 10 daily candles. Like for example, if the last 10 days expanded for 500, 450 or 550 points, so it will count the average of that, and it will show you what's the current range is, how much percent of the ADR is used, what is the remaining ADR, what is the bias, is the ADR exceeded, are we getting expansion, are we getting a reversal, what is happening right now. The indicator will show you all of this. I've screenshotted this from the current NQ price section. We went lower, exceeding the ADR, so we weren't expecting a further expansion. So what we did, the indicator plots the line to the opening price of the candle, and the price returned back into it. This is just an example, a schematic, so we will be going over this in detail. So going into the next slide, uses of the ADR indicator. The first use is overextended range or breached ADR. So if you are entering the new session and the ADR is already fully breached, like for example, if it is above 95 or 100%, that means the daily range has expanded overnight or prior session to the new session, and you are not expecting a further expansion. So you have two choices: either skip the day, which is good, or if the price has reached into a key level, you can trade back towards the equilibrium of the ADR projected line. If you have like expanded for 80 to 90 points, the ADR will draw a line on the opening price of the candle. If the objective is met, the price is going to reverse to the opening price, which will be applying that quick logic ladder. Now under extended ADR, if the newer session begins and ADR is like under 60 or 50%, that means the daily candle has used 50% of its range and it has not still expanded. So what you can do is you can count that as a high probability, and you can target large objectives until the ADR is reached or a higher time frame liquidity levels. And this is the med used ADR. Like when ADR is above 60% or 80%, then you have like 30 to 40% of the ADR left going into the newer session. So what you can do is you can target small objectives, and because the majority upper range is already used, but we still have like 30 to 40% of the range left, so you can target small objectives. So the first setting is the look back period. You can use the ADR indicator with 10 to 20 days look back, which gives you the realistic and recent representation of the price action. The 10 is the good spot. Why? Because if we are in a large range environment, if the daily candle is expanding to the all-time highs or printing large daily candles, then you will use the current trend like 5 or 10 days, because if the last candles have expanded, then the current candles have the potential to expand higher. So you'll be using the last 5 or 10 days. Now small range environments, like for example, the gold expanded for 2 months and then started small ranges. After large ranges, we are getting small ranges, expansion into another feather price delivery. So we will be using last 3 to 5 days. Why is that? Because if we are in a small range, the daily candle will be small enough. So you will use the last number of days which are included in that consolidation or small range. The best case is using 3 to 5 small range days, so it can give you the realistic expectation for those small range environments. Like for example, if the goal is printing 150 points on average expansion day, and if you are in a small days environment where goal is printing 70 or 50 points, so you are going to adjust the indicator setting to 3 to 5 days, which will give you the average of those 50 or 70 points, so you can get a realistic expectation. And once the price is expanding again, you can set the ADR projection again to its settings. Now the wick formation concept, this is for the reversal days. If the price is already expanded in opposite direction, it made a high time frame key level, then your trade idea is shifting towards the opening price. So if the ADR is used 90 to 100% reaching a key level, if you're expecting a reversal, then the indicator is gonna puts that line on the opening price, so you can target that. Now, high impact news days and days like FOMC, CPI or non-farm payroll, it is normal to breach the ADR because we have a large volatility driver, so the ADR can expand up to 200%, 250%. It depends on the price section. This is not a very mechanical tool, but it is the average of the last 8 days, and you are finding that on the current chart. Now, these are the indicator settings. I have also plotted an eye icon which can help you with the settings. I have added it to every one of the settings. So the first one is the ADR lookback. You are going to adjust the lookback period, enable the reversal threshold, mean reversion. I'm going to explain it to you in the charts. In this setting, you can set the extension of the line, how much you want it extended to the right side. So the 10 is optimal spot. Now the ADR threshold, if the 100% is breached, it is going to give you a danger sign. So you can adjust those settings, expansion threshold, and these are the colors. I'm going to explain it to you in the chart. So let's hop into the trading view. So here we are on the trading view. First, let me show you the indicator settings. So first we have the ADR lookback days. In the setting, it will show you the number of previous days. So the default setting is 10 days. Now the advanced projection settings, the first one is enable reversal threshold. If the price is expanded 90 points in one direction, if you enable the reversal threshold, it is going to plot a line on the opening price of the candle. If the price is reversing from there, then you can trade into the opening price. Now the mean reversion threshold, if ADR has expanded in one direction by 120 points, then you can target 50% of the current candle's range, which I will show you in the examples. Now this is the table information. The table is shown on the top right side. Now the display settings. Now this is for the ADR projected lines. It is set to 25. If I'm setting it to 10, then it is gonna reduce the line extension from the right to 10. Now the threshold, if the ADR is exceeded, if it's reached 100%, then it is gonna give you a sign warning right here that ADR is exceeded. Now the expansion threshold, if ADR is at 50% or below it, then it is gonna give you a sign up that the current candle can support expansion. 85%, which is the ADR almost reach sign, and between the 50 and 85%, which is mild expansion, it is below 80%, so the candle has the potential to expand. Now these are the ADR line styles. The upper line will be shown as a bullish green and the lower line will be shown as a red, and this is the width and style up these colors. First, let me give you the idea of how to use the look back period. So for example, if we go into these expansion days, as you can see, the ADR is set to 10 days look back period. The average daily range is 80 points and the current range is 78 points. So all the candles will be expanding up to 80 points because we have seen it historically. The candles are expanding in continuous direction to all-time highs. So you're gonna set the ADR threshold to last 10 days or 5 days because we are in an expansion environment. Now after large ranges, we reverse up at all-time highs, and now we are building small ranges. We are inside a range or consolidating. So I'm not gonna be expecting 151 point trade from the candles now. So what I'm gonna do is I'm gonna set the look back to last 3 days or 5 days. So if I go to the setting and set it to the last 3 days, so it is gonna give me the realistic expectation that the average daily range is 121 points, and as we are consolidating, now it is counting the range up the last 3 days, which is 88 point. And as you can see, the price is narrowing down. It is giving us the range of 76 point. For the next candle, it is now printing small candles, so it will automatically measure the ranges of the last small range candles. If I'm setting it to like 20 or 30, so it is going to count all these expansionary candles. So the ADR projections will be unrealistic. So you are going to put it to 3 or 5 days if you are in a small range. If you are in a continuous expansion and the price is continually expanding in directions, we're going to put it to 10 or 15 or 5 days. So this is the realistic expectation. As you can see, we are building up and the range is narrowing down. 67 point average daily range. We have started expansion again, and now I can set it back to 5 days because we are starting an expansion now. So it is going to give you now the expectation of the last 5 expansionary days. And as you can see, from that point onward, we are building large ranges. So I'm going to put it to 10 days. And now it is giving you a realistic expectation that the average daily range is 79 points. And This is how you can use it for the ranges. If you are in a small range, set it to 3 or 5. If you are in a large range, set it to 5 or 10. And you can mess up with the indicator and find it yourself. So this was the idea of how to use the look back periods. Now I'm going to give you the example how you can use an ADR indicator going into the nearest session in a trading day. So let's hop into the example. Starting with the first example, here I am on the gold hourly chart. This is Tuesday's price action from the current week. As you can see from the opening price, we have manipulated a key level, and we do have a change in the state of delivery, a confirmation for the bullish expansion, and we are expecting an expansion higher to all these failure swings. But would I expect an expansion to these highs in this same day? No, because what is the average daily range? We have the look back period is set to 10 days. The average daily range is 92.7%. The current range is used for 73 points. We have used almost 80% of the ADR. The remaining range is 19 points. So it is plotted that remaining range with this projection right here. That green line is the threshold we will be reaching in this specific day. So going into the new session, the 8 AM candle already expanded higher. Or if I'm positioning myself within here with a fair value gap or something, my targets would be the average daily range or the drawn liquidity attached to it, which is this high right here, because I cannot expect further expansion out of this day. So on the 9 AM candle, we have printed a retracement candle, and with the next candle, we have tapped into a fair value gap. Now we are starting an expansion higher. So what are my targets for this expansion leg? The first one is the current range high, which is from this current day, which is a realistic high or this ADR projection. And the price cannot get to the exact point of the ADR, but it can give you the idea that we are going to reach to this high because we are wrapping up the ADR and the price is showing ADR is almost reached. So we are going to target small objectives. So letting the price action play. And as you can see, the price started to print a small range candle because the ADR is almost reached. And this day was designed to print that much of the range. So it is not going to expect much further. And as you can see, after reaching that high and we are wrapping up, we are in between the ADR boundaries. So this indicator is showing you this 90% of the ADR is used. If you are trading the PM session or later 12 PM never, so you won't be trading it because we have used too much of the data range expanding from this low towards this current range. So we are, as you can see, the new day started and it plotted the new projection line. If the daily candle is expanding to the upside, it is going to expand that much to the upside. And going into the Asian session, you can see we have used only 13% of the ADR. So it is showing that possible expansion as we move into the newer session. Now the ADR projection lines are moving alongside. As we are moving into the newer session, this line is going upward because from this low to this high, we have used 47% of the ADR. So we'll be expecting if the price is reversing from these highs, it will be to this point and the price is printed a new high if the ADR is expanding to this point. So we are going to expect a return back to this if it is reversing, or if it is going higher and not reversing, then this is the threshold for that. Now going into the newer session. So now that we are manipulating this high and starting to reverse lower, the 10 AM candle was a reversal candle and we are not expecting much higher. So what we are going to do is we are going to enable the reversal threshold because we can see that now it is reverse up of that high. So going into the indicator settings, I'm gonna enable the reversal threshold. So what it's gonna do is it is gonna draw the ADR projections to the opening price of the candle, because since we have created a large wick and we have succeeded to reverse at that high, so now it is gonna go to this projected line, which is aligning with the opening price of the candle due to the large wick. As you can see, after hitting that objective, that ADR level, now the price has closed. Since we have a bearish price, so we are going to be expecting this day to move lower. 94 points, 94.6, which is the ADR indicator is showing for us. And we have used 33% of the ADR, so we are expecting a possible expansion lower. The remaining ADR is 63.3 points. Now we are going to go over the mean threshold and other settings. Now going into another example here, I'm on the NQ hourly chart. This is 14th November, Friday's price action. So we are going lower and we are leaving this fair swing and establish high of the day. So if you are expanding lower, then the projected line for the ADR is this red line right here, which is 493 points of expansion lower. The current range is 1 under 38. and we are having a possible expansion. So going into the newer session, as you can see, the price drawn towards the ADR and it is now breached, and we have used 108% of the ADR, which is 533 points. So the ADR indicator automatically plots the line and the opening price of the candle. So it means that we have succeeded to manipulate at 9 a.m. So we are going to drop back to the opening price of the candle. So in these cases, you have to enable the reversal threshold if you are trading the reversal day. But we also have a failure swing just slightly above the opening price of the candle. So either you can trade towards the opening price mechanically, or you can use a little bit of discretion and target the equal high above that. So now going into the session, as you can see, we have banded now higher. Now I'm going to show you how to use the mean threshold when the ADR is exceeding by 120 points. Now going into the NQ hourly chart, this is Friday, 7th of November. So we have a key level on the daily chart lying right here, and going into the newer session, what have we done? We have used 126 points of the ADR. So we will be not expecting much further expansion. When we are reaching into a key level, the ADR is showing exceeded. You cannot trade it further lower. So what you are going to do is you're going to trade back to the opening price. But since it is a very large candle, we have used 126 points to the downside. So what we are going to expect, the midpoint of this expansion from this current day high to the current day low, which we will be printing right now. So going into the 12 p.m., as you can see, we are succeeding to manipulate this low. We are not much continuing lower. And at this stage, we have used 153% of the ADR, which is very, very large range. So now the ADR indicator has plotted a line on the midpoint or the 50% of this whole range. If I measure it from the high to the low, it is matching with the 50% of the range. So when we are using above 120% of the ADR, then we are expecting a return back into the midpoint if we are manipulating the low or the high, which we are reaching into. So as you can see, going into the PM session, we have expanded to the midpoint. And if you are mechanically targeting the 50%, you have to align a PT array with that. So we have a fair value gap right here. You can target it, which is aligning with the 50% or the mean reversion point. Since we have expanded 150 points to the downside, we are going to expect a return back to the 50% of the current range. And this is the setting for that. This is enable mean reversion. The threshold I have put for it is 120 bytes. You can do it to whatever you want, but a 120 point is optimal because I have seen it or a few examples. Now this is the example where we are expecting possible expansion from the candle. So as you can see, approaching the newer session, this is the 8 a.m. From the opening price, from this low to the high, we have used 205 points of the ADR, which is 43% of the whole range. And we are expecting a possible expansion. But what have we done? We have manipulated the Asian session highs, and we have a candle 2 closure right here. So if we are going lower, we need a continuation order block, and we are gonna target the ADR projection, which is aligning with this level and this right here. So we are gonna target this one, and we have 267 points of the ADR left. So dropping down to the 5-minute chart. So dropping to the 5-minute chart, you can see the reversal candle has a large change in the state of delivery. So I'm not gonna put my stop loss 60 points. So I'm gonna go to the 15-minute chart, and as you can see, we already have an order block printed right here. Up close candles followed by closer below. If I'm entering here, putting my stop loss above the bodies, which is 45 points, and let's say I'm targeting this low, which is aligning almost with the ADR projections. And since we have used like 40% of the ADR, we have left 60% of the ADR in the day, so we are expecting expansion 9:30. Now this is how you can use the ADR for the possible expansion or possible reversal or widening the session scenarios. So now we have used 88% of the ADR. Would I be expecting an expansion from this point lower? Yes, I can, but it will not likely happen. So I'm gonna be not trading after the 10 a.m. And now the session is over for me. This is how you can avoid the lower probability situations. So I'm gonna give you another example. So now here we are on the gold hourly chart, which is Friday, 14th of November. As you can see, going into the newer session, we have printed a small wick, and we have expanded lower by 200%, and we have used twice the ADR. So would I be expecting further expansion lower? No. So what I'm gonna do is either skip or target the mean reversion point, because after expanding to the downside, the candle is gonna print is opposing wick drop back to the opening price since it is consumed too much of the range. So what I'm going to do is I'm going to enable the mean reversion threshold, and it is going to draw a line on the 50% of this range. So if I'm approaching, now we have a reversal candle. So we are going to target this fair value gap. We have traded back to that mean reversion point, which was aligning with this fair value gap, and we have ended up the day. So if you are approaching the new session, the best scenario is to skip that day because we have used the ADR by 200%, or either target the mean reversion point, which is the 50% of this whole range. So I'm going to wrap up my video here. Hope you guys have learned something from that, and the indicator will be published after this video's release, and it will be absolutely for free. Thank you guys for watching. Make sure to subscribe to the channel and like the video, and see you in the next week.